Thanks, Gwen, and thanks for having us back again on your panel. We've been busy, as you suggested, for the last 12 months since we were here last, and it's my objective to report on that this morning. Oh, there we go. I'd like to start off with this slide because I think every company needs to talk about differentiators. I have a series of differentiators that I think Atlantic Gold has, and I'm going to bring those in line by line. But the first one I'd like to talk about is the fact that I think we're the only company with a market cap of the order of $250 million or even close, where we as board and management are backing ourselves with our own money. We've basically put in the equity that was required again, alongside the bank debt to make this project happen. This was before the market turned up in the summer of last year. So as a result, we own about 35% of the company. So we are very aligned with you as shareholders. Track record of company builders. My background, I was president of Tech, the company that Kerry was talking about earlier, through to 2002. Prior to that, I was one of the founders of a company called Normandy Mining, which was sold to Newmont and Franco-Nevada for about $4.5 billion in the late 90s, and the founder of a company called Pacmin. So this is my third gold company that I've been involved in and part of the leadership to start. My partner and COO, Maurice Belanger, is also another senior company person. She was a former senior VP at Corp and senior VP at Kinross. She's a 30-year career. There's not a gold project that she hasn't seen or been to. We're privileged to have her as part of our team in the entrepreneurial phase of her career. Focus on risk. We've had lots of discussion earlier already about whether it's good to be lucky in this business or whether you just need to build things. I think it's good to have both. But what I will say is that this business, as you all know, as I suspect seasoned professional investors in this business is pregnant with risk, but that also generates returns. But that doesn't mean that you should not focus on managing and reducing those risks. And that's one of our differentiators, I think. And what I mean by that in our case is, firstly, things like fixed price contracts for the construction of our plant. We are building the first fixed price gold plant in North America, in Nova Scotia. In other words, those risks related to overruns have been largely eliminated because of the nature of this contract. We've done an extensive program 2 years before we started construction on what's called grade control drilling or production density drilling, which gives us a very, very high level of confidence on a 5x5 or 5x10 grid basis of what we're going to send to the mill in the first critical 12 months of startup of our business. And a little bit of hedging to make sure we pay our bills, and because we've got some bank debt, that's an important thing to do as well. We are going to get into cash flow in the Q4 of this year. It's coming awfully fast and quick. We've got some serious upside in what I call our string of pearls concept, where I think there's a very real chance that we'll double our production in the next 3 years. And in September, we'll be in a position to release the results of some of the exploration drilling that Gwen referred to. And the idea is we'll incorporate those into the life of mine plan about the same time as we kick off our base case project. Just touched on that, and the final point I make is time is money. Mining companies and exploration companies tend to forget that your money that you put with us actually does cost us, and time is money in the sense that unless you get on and push towards production in the shortest possible time frame, the returns that you are projecting are going to diminish with overheads and property holding costs. So time is money, and particularly when you remember that we, like you, are shareholders, and our money is important in terms of those returns. That's where we are. We refer to as backyard Canada, but I think that's important. We're in Nova Scotia. Not that Nova Scotia should be seen as a backyard, but it's backyard in the sense that it's a very easy location, and I'll talk about that in a moment. Quick summary of some of the economics. Really strong economics for our base case, 214 million NPV at today's gold price, 34.8% IRR after tax, base case production of 87,000 ounces, 1.9 year payback at today's gold price. Very strong economics. I think the best economic representation is one where, where what cash flow are you going to produce? And at today's gold price, based on our projected all-in sustaining cash cost of $690 Canadian an ounce, we're going to produce a margin of about $1,000 an ounce. So at our base case startup production level, that's about $90 million Canadian a year. Our market value today is $250 million thereabouts, so we're less than 3 times our base case operating cash flow. Pictures tell 1,000 words. We are well advanced in construction, as these pictures will exhibit. Ball mills in place, tanks, mill building, reagent building. The crushing equipment is ready to be installed on a modular basis. It's been a 15-month, it will be a 15-month construction schedule. We're about into month 10 on that, and we are on time and we are on budget. That's an aerial of the property with the mill in the foreground and the pit and the tailings area in the background. Another pretty picture. Expansion scenario. You can't sit still in this business. It's a depleting business by nature. As soon as you get into production, you're going to have to replace those ounces. We're already on top of that in terms of being well advanced in an exploration program which will drill off to a measured category resources that are currently in inferred and indicated to the total of about 1.1 million ounces in 2 satellite deposits called Cochrane Hill and 15 Mile Stream. We'll have a new resource statement at a measured basis by mid this year, about end of June, early July, and we'll have those ounces incorporated into a new life of mine plan by September, once we've done our engineering around those ounces. We're also expecting to discover one more deposit on our string of pearls concept, and I'm pleased to say that we've already done that in the Plenty prospect. We've got some very, very exciting numbers out of drilling there that we've just released in the last month or so. We've got an 80-kilometer strike length of mineralization and structure that is essentially unexplored for the concept that we have being the first open pitable gold mines in Nova Scotia. Every other gold mine that's been mined in Nova Scotia since the 1830s have been underground mines focusing on what they call the saddle reefs. We're looking at a package of rocks which are all mineralized, the argillite host rocks hosting the old quartz veins that used to be mined, and we're mining it all within 50 to 100 meters of surface. Really shallow, low strip mineralization. First time it's been done and a first time new look at Nova Scotia and the geology in the Maguma terrain. This gives you a sense of what that expansion scenario could do. Our 2014 PEA focused primarily on Cochrane because that was the only satellite deposit that was not in our life of mine at that stage. 15 Mile was still not yet drilled off. Cochrane Hill will add, as this indicates in the PEA, significant ounces to our production on a satellite pit feed basis. As will 15 Mile Stream. We've yet to determine that, and that's the subject of the study that I'm talking about that we will release in September once the drilling has been completed. In terms of valuation, I'd reference that 90 million operating cash flow, but the other way to put it, the other way the broker and the analysts put it is, where do we sit alongside our soon-to-become junior gold-producing peers? We're trading at about 3.2 times our cash flow earnings. If we double our production, as I'm hoping to in September, that number comes closer to 1 or 2 times cash flow. That's not sustainable. What that means is that we will feed into some of the similar multiples of our peer averages, and we're in backyard Canada. We're not in Burkina Faso or in the jungles of Brazil. We're in backyard Canada, 45 minutes from Halifax. Just to summarize, I've got 11 seconds to do. It is not easy to do, is it? We are close to cash flow. We've got some differentiators. I talked about those. Focus on risk. We got a lot of board ownership. We had a record of building companies before, and we've got a real potential to expand our production in the near future. Thanks for listening.